Hello and welcome. In this mini-series, I'll show you how to create journal entries related to purchasing and selling options. This mini-series is not meant to teach you about options trading, but instead teach you how to create the journal entries for options. It is, however, important to know a little bit about options before proceeding. Now, in short, options are financial contracts that give the option buyer the right, but not the obligation, to buy something or sell something at a specified price called the strike price within a specific time period. That something is usually a stock, bond, or commodity, which is sometimes referred to as the underlying asset or simply the underlying. In this mini-series, we will discuss journal entries for each of the various types of options from the perspective of the option buyer and seller. There are two types of options: call options and put options. A call option gives the buyer the right, but again not the obligation, to buy something at a specified price within a specific time period. A call buyer profits when the underlying asset increases in price. One way to think about it is that if the price goes up, the owner of a call option has the right, but again not the obligation, to call away from the seller of the options contract the underlying asset at the strike price. A put option gives the buyer the right, but not the obligation, to sell the underlying asset at a specified price within a specified time period. A put buyer profits when the underlying asset decreases. Again, another way to think about a put option is that if the price goes down, the owner of the put option has the right to put the underlying asset on the seller at the strike price. He doesn't have to, but he has the right to. To learn more about options, I recommend checking out Investopedia. It has a nice explanation of the various terms used in options trading. I'll put a link in the description below. For this example, we'll assume that Coyote Incorporated thinks the price of Acme rockets will go up within the next 3 months. So on August 1st, Coyote Inc. buys a call option to buy 1,000 shares of Acme rockets on or before October 31st for $800 at a strike price of $100 per share. At the time the call option is purchased, Acme shares are trading for $100 per share. On September 30th, at the end of Coyote Inc.'s quarter, Acme Rocket's share price is $125 and the time value of the call option is $300. On October 30th, Coyote sells the call option to close its position. Acme Rocket's share price is $117 and the call option has a time value of $50. Now, since an option is simply a financial asset, its purchase really isn't any different than purchasing any other asset, such as a building or supplies. To record the purchase, we debit the call option account for $800 and credit the cash account for $800. To adjust the value of the option, we need to know a little bit more about options pricing. All right, an options price is made up of two components: the intrinsic value and the time value. The intrinsic value is the difference between the current share price of the underlying asset and the strike price, multiplied by the number of shares specified in the contract. In our example, the intrinsic value is the current share price of $125 minus the strike price of $100 times the 1,000 shares, or $25,000. The time value is given in the problem statement as $300. To adjust the value of the call option, we need to increase its value due to the increase in the intrinsic value. To do this, we debit the call option account for $25,000. Since debits must equal credits, we credit an unrealized holding gains or loss income account. If the share price had been less than the strike price of $100, say for example $90, this entry would not be made because the intrinsic value cannot be negative and we wouldn't enter in a zero entry. We're told the time value is $300. Now, since we purchased the option for $800, we need to reduce the time value of the option by $500 to show the loss in time value. To do this, we reduce the unrealized holding gains or loss account by debiting it $500 since debits reduce an income account. To reduce the value of the call option, we credit the call option account by $500 since credits reduce an asset account. In a future video, I'll show you how to simplify this entry by looking at an option chain. But for now, we'll determine the adjusting entry in 2 steps with 2 journal entries. When we sell the call option, we're told that the share price for Acme Rockets is $117. Therefore, the intrinsic value of the option is $17,000. That is, the $117 share price minus the $100 strike price times 1,000 shares. Since we previously adjusted the intrinsic value to $25,000 on September 30th, we need to reduce the intrinsic value by $8,000 to lower it to $17,000. To do this, we debit the unrealized holding gains and loss income account by $8,000 and credit the call option account by $8,000. To reduce the time value, we follow the same procedure as on September 30th and debit the unrealized holding gain or loss income account by $250 and credit the call option account by $250. Now we can calculate the carrying value of the call option using a T account. We see that the entries for purchasing and the various adjustments gives us a carrying value of $17,050. This should make sense since we're told the time value is $50 and we calculated the intrinsic value to be $17,000. To record the sale, we debit cash for $17,050 and credit the call option account for $17,050. This zeroes out the call option account. To record our realized gain, we can look at each of the transactions to see their effects. On September 30th, we increased the value by $24,500, and on October 30th, we reduced the value by $8,250. Thus, our total net income is $16,250. A T account for the unrealized holding gain or loss income account will show the same result. We record the gain, to record the gain, we transfer the unrealized gain to a gain on sale of investments account to realize the gain of $16,250. And that's it. We have recorded the various entries for purchasing and selling a call option, as well as adjusting its value. We can post the entries to the general ledger and we're done. Now let's look at a different example where instead of selling the call option, Coyote Inc. exercises its right to buy the 1,000 shares of Acme Rockets Inc. We have the same information except that instead of selling the call option on October 30th, Coyote Inc. exercises the call option to take delivery of the 1,000 shares at a share price of $117. The previous journal entries for purchasing the call and adjusting its value on September 30th are the same. The journal entry for reducing the intrinsic value from $25,000 to $17,000 is also the same as before. For the time value, we reduce it to 0 instead of 50 since once exercised, the call option has 0 time value. Again, we can calculate the carrying value of the call option using a T account, and we see the entries for purchasing and the various adjustments gives us a carrying value of $17,000. Again, this should make sense. Since we just calculated the intrinsic value to be $17,000 and we reduce the time value to 0. For the unrealized gain, we again use a T account and see that the balance for the unrealized holding gain or loss income account is $16,200. Intuitively, this should make sense as well. The call option has a value of $17,000, but Coyote Inc. paid $800 for the option, so its gain should be $17,000 minus $800, or $16,200. To record the stock purchase, we zero out the unrealized holding gain or loss income account by debiting it to $16,200. We will zero the call option by crediting it $17,000 intrinsic value. We will also credit cash by $100,000 to pay for the 1,000 shares at the strike price of $100. The credit to cash and the call option account, as well as the unrealized gain, get rolled into the basis for Acme Rocket stock. We need to determine the debit amount for Acme Rocket stock to make debits equal credits. Doing the math, we see that the debit for the stock should be $100,800. Again, intuitively, this should make sense since Coyote paid $800 for the call option and $100,000 for the stock. Right, and that's it. We've recorded the various entries for purchasing and exercising a call option, as well as adjusting its value. We can post the entries to the general ledger, and we're done. In future videos, I will go over journal entries for shorting a call option, both purchasing and shorting a put option, as well as showing the results on quarterly financial statements. Please like and subscribe so you don't miss out. Thanks for watching.